Today we are going to be talking about Alibaba. We will start by taking a look at recent downgrades from Morgan Stanley on Alibaba's stock price. Then I want to discuss a recent fine from the PCAOB on Chinese auditing firms. Also, President Xi visited the US a few weeks back, and I wanted to go in depth on some of those visits and what they could mean for the Chinese economy. Then we will discuss Chinese interest rates, as well as Alibaba's valuation, their EPS numbers, and finally their revenue. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. First off, let's take a look at Alibaba's stock chart. We can see that over the last 5 years, Alibaba is down almost 52%, and from their all-time highs of over $310, we can see that the stock has crashed more than 75%. And a lot of this crash has to do with tensions between the US and China, but also the weakening of the Chinese economy. And it certainly doesn't help when we have companies like Morgan Stanley downgrading the stock. Morgan Stanley came out just the other day and announced that they were moving their price target down from $110 for Alibaba's stock price to $90. The crazy thing is, even with a $90 price target, this represents a 21% upside for the stock. And honestly, I always take these price targets with a grain of salt because no one knows where the stock is going over the next year. We can see that on Nasdaq.com, their analysts have an average price target of $124.74 with a low of $90 and a high of $150. And personally, my price targets are just in line with these analysts as well. I think $120 to $150 is very reasonable because that would only be a forward PE ratio between 12 to 15. My best case scenario price target for a year out from now would be actually $200. What that would be is a forward PE ratio of a 20, which I think would be achievable, especially if we start seeing interest rates drop and money start flooding back into China. One issue with that scenario is the continuation of tensions between the US and China. Just this past week, we saw US regulators levy their largest ever fine against Chinese auditors. This fine was for $7 million against 3 Chinese-based auditing firms for a variety of offenses, including issuing a false auditing report. The Public Company Accounting Oversight Board, which oversees auditors of public companies listed on US exchanges, announced Thursday that it had imposed fines against PwC China and PwC Hong Kong for improper answer sharing by hundreds of employees on tests for mandatory internal training courses. Obviously, this is a very bad look for Chinese auditing firms, and even the PCAOB chair announced Thursday that the days of China-based firms evading accountability are over. If you only read the headline and maybe the first couple paragraphs of this article, you would think that this is very bad for China companies in general and them staying listed on the US stock exchanges. However, what we find if we dig a little bit deeper is that the PwC Hong Kong and China actually self-reported these violations. And that is big because it shows that China is no longer trying to hide anything from the US. They want to cooperate with them, they want to work closely with these auditing firms and make sure things are done by the book because they want US support. And we have seen that also from the president of China actually visiting the US. And President Xi not only met with Joe Biden, the US president, but also met with US business leaders. The dinner party with President Xi included the likes of Tim Cook, the CEO of Apple, as well as Elon Musk and Blackstone's Steve Schwarzman. Other notable attendants were the CEOs of Salesforce, Boeing, FedEx, Visa, Pfizer, MasterCard, and BlackRock. Overall, the news out of these meetings was very positive, but in my opinion, when I look at these meetings and the fact that China met with a lot of tech giants in the US, this should be a very good thing for Chinese companies as well. Because what we have seen over the last few years is China's president has locked down on a lot of these Chinese companies and fined them for being monopolies. And now that he's meeting with a lot of these US-based companies and trying to get their investments back into China, I think this speaks to the fact that China is going to loosen up a lot of the restrictions on Chinese companies and help promote economic growth. And one of the ways they have looked at doing that is by lowering their interest rates. We could see that China has actually taken a very slow approach to lowering their interest rates. They were sitting at a 4.15% interest rate in January of 2020, and that has only dropped down to a 3.45% interest rate in November of 2023. What this ultimately shows is that China still has some room that they could lower interest rates even further and help promote growth throughout the country. And when we start seeing money become a lot cheaper in China, that will be a good thing for growth, especially in terms of EPS and revenue numbers, and ultimately that will affect valuations. right now Alibaba is sitting at a forward P ratio of 7.4. And Alibaba has done a very good job of turning around their EPS numbers over the last few quarters. They don't have their most recent quarter actually listed in here yet, but if we did see it listed, it would be very close to this quarter back in September of 2021, where they hit $7.20. And at this time, the stock price was trading around $170. And in their most recent earnings announcement, they actually saw their revenue grow 9% year over year. So personally, I think there are a lot of good things moving forward for China and Alibaba. I think if we see China get back to growth, this is going to help Alibaba grow in a massive way due to the fact that a lot of their customers are obviously Chinese based. And what we could see if China starts getting along with the US is valuations for Alibaba as well come up, because there will be less concerns around fines, restrictions from the US, and anything else that could prevent growth throughout China. What we're starting to see is China and the US become more friendly. Over the last couple of years, we've seen a lot of kind of headbutting between the two countries, and I think if we start seeing them get along a little bit more, that is going to be a big benefit for Chinese-based companies. So I've actually been buying more into Alibaba. I have built out a very good position, and I didn't really want to make it any bigger, but with these positive signs showing and the stock still trading at ridiculously low valuations, I wanted to add a little bit more, lower my cost basis even further, and get into a company that I believe in for the next few years, and that is Alibaba. But keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all of that said, I hope you enjoyed the video. If you did, drop a like down below, and if you want to see more videos like this one, subscribe. And as always, guys, have a wonderful rest of your day.